Welcome to today's Explainer. We're diving straight into the absolute behemoth that is the global mortgage market. I mean, we all know what a house is, right? But the actual financial engine that makes buying one possible? It's this sprawling, endlessly fascinating system that literally connects the front doors of our local neighborhoods straight to the largest financial capitals in the world.
To really wrap our heads around the sheer scale of what we're talking about, we have to start with this mind-boggling figure. Between $60 and $70 trillion. Just let that sink in for a second. That is the total outstanding global mortgage debt today. It's a number so large it's almost impossible to picture. But here's the kicker. Every single dollar of that staggering figure represents a real agreement, a real home, and a very real piece of collateral.
And that brings us to the ultimate question we're unpacking today. How exactly does an everyday home purchase, just you or me buying a house, plug into this massive, interconnected global financial machine? Basically, how do we go from a family unlocking the front door of their new place to a multi-trillion-dollar asset class that's actively traded by international investors?
Chapter 1. The Kitchen Table. Let's start small, right at the kitchen table, with a guy we'll call Henry the homebuyer, who's looking to enter the primary mortgage market.
At its core, the deal Henry is signing is a mortgage. And unlike just swiping a credit card, Henry's loan is totally unique because it's collateral-backed. He's essentially signing a contract that says, hey, if I stop paying, you, the bank, have the legal right to take my house. It sounds a bit scary when you put it like that, but because the loan is secured by that physical, tangible property, the bank feels safe handing over hundreds of thousands of dollars. Now, Henry is sitting there staring at an amortization schedule for a massive 30-year commitment, and wow, is he in for a shock. He quickly realizes that in the early years of this mortgage, almost all of his fixed monthly payment goes entirely to interest, not the principal. For the first few years, he is barely paying off the actual bricks and mortar of his house. And this perfectly illustrates Henry's dilemma. His banker points out that if he just chose a 15-year loan instead, he'd save a staggering $119,808 in total interest, almost $120,000. But there's always a catch, right? That 15-year mortgage pushes his monthly payment up to almost $1,095 compared to just $880 for the 30-year option. Faced with that, Henry goes for the 30-year option, purely to keep his day-to-day life affordable.
Chapter 2. The Exotic Neighbors. Because obviously, Henry isn't the only one getting a loan on his block. Let's see how this market adapts to some pretty exotic alternatives.
The market basically shapeshifts to fit everyone. For example, the neighbor buying that massive mansion down the street, they need a jumbo mortgage because their loan easily exceeds the standard government limits of around $726,000. Meanwhile, another borrower with a weak credit history might only qualify for a subprime mortgage, which naturally carries a much higher interest rate to offset the bank's risk. And then you have the senior citizen next door taking out a reverse annuity mortgage. This one's wild. The bank actually sends a monthly check to the older homeowner, allowing them to literally live off the equity they've spent decades building up.
Okay, Chapter 3, the securitization blender, because this is where Henry's assumptions about his loan are completely flipped upside down. Henry probably assumes his local bank just locks his 30-year loan safely in a vault. Not even close. To avoid locking up their cash for 3 decades and taking on all that interest rate risk, the bank uses what's called the originate-to-distribute model. It works like this. Step 1, the bank makes Henry the loan. Step 2, they turn right around and sell it to a massive government-sponsored enterprise like Fannie Mae or Freddie Mac. Step 3, Fannie Mae throws Henry's loan into a giant blender along with thousands of others to create a single mortgage-backed security, or MBS. And Step 4, this newly bundled security is sold off to global investors. We're talking pension funds in Japan or insurance companies in Germany.
And to put the sheer scale of this shift into perspective, just think about these numbers. Back in 1992, the actual local banks held almost half of all mortgages, about 49.2%. But fast forward to 2021, the bank's share dropped to 37.1%, while federal and related agencies absolutely exploded, from a tiny 0.4% all the way up to 38.3%. The secondary market has basically taken over the whole shebang.
Chapter 4, the transatlantic divide. Let's zoom out even further and look at how this entire system totally changes depending on which side of the Atlantic you're on.
So the U.S. market is highly market-based. It leans heavily on capital markets, that originate-to-distribute securitization model we just covered, and it loves offering fixed rates to borrowers like Henry. Europe, completely different story. It's a bank-based, highly fragmented system that uses an originate-to-hold model. The banks actually keep the loans on their own books. And instead of fixed rates, European mortgages are mostly variable rate, meaning your monthly payment goes up or down directly tied to central bank policies.
Now, because European banks generally hold onto those loans rather than selling them off, they frequently use complex synthetic securitizations. Essentially, they pay investors to take on the risk of default without actually selling the underlying loan. And the result of this massive structural difference? Well, in 2021, the US completely crushed it in global securitized asset issuance, pumping out nearly $2.99 trillion. Europe, just $197 billion. It is a fundamentally different way of viewing finance.
Chapter 5. The Storm. Because we have to ask the absolutely crucial question, what happens to this highly connected $70 trillion global machine when that blender breaks?
Well, we all know what happened in 2008. The system completely broke down. Way too many toxic, high-risk, subprime loans were just thrown into those MBS blenders, and the securitization process effectively masked how dangerous they really were. So when the housing bubble finally popped and those subprime borrowers stopped paying all at the exact same time, it triggered a devastating domino effect. The shock didn't just hurt the local town banks. It traveled instantly through those mortgage-backed securities and completely froze the global financial system.
The panic was so intense that the U.S. Treasury had to step in with unprecedented action. They literally had to pump $119.8 billion into Fannie Mae and another $71.6 billion into Freddie Mac. We're talking nearly $200 billion just to keep these massive securitization engines solvent and stop the global economy from flatlining. And honestly, the legacy of that storm is still with us, as those entities remain under intense government oversight today.
Ultimately, what this explainer really drives home is one profound truth. Mortgage markets are the literal bridge between a family's front door and the furthest, most complex reaches of global capital markets. So whether you're Henry, sitting at your kitchen table stressing over a 30-year amortization schedule, or a massive institutional pension fund manager in Japan buying up mortgage-backed securities, our financial fates are completely, undeniably intertwined.
Knowing how this incredible, sometimes chaotic, global machine operates, how risk is transferred across oceans, and how it directly impacts the houses in your very own neighborhood, it leaves us with one incredibly important personal question to ponder. If you were sitting at that kitchen table right now, would you prefer a fixed or variable mortgage today?